Hello and welcome to EverThrive's market update for the month of March. This month, we're focusing on current events, including the triple T's Trump, tariffs, and taxes, and what those things may mean for you as an investor. I'm Valerie Leonard, founder of EverThrive Financial, and I will try to break this all down for you in a few short minutes. I'm joining you today from Canada, and it has been a delight to enjoy this beautiful country over the past few days and to be welcomed by our great neighbors to the north, despite the tumultuous trade war going on between our two countries. If you ever get a chance to visit Victoria, British Columbia, I highly recommend it. Okay, so here's a quick preview of what's to come in this video. We're going to talk about proposed changes under the Trump administration, updates on the new tax bill, tariffs and their potential impacts, inflation and interest rates, and what investors may need to do going forward. But I want you to stay tuned to the very end of this video because I have a special bonus tip for you this month. And you're going to want to pay attention to our top 5 things to understand how the bonus tip can help you potentially navigate the coming few months. All right, so let's start off with what may change under the President Trump administration. Now, he hit the ground running clearly right out of the gate with executive orders and proposed policy changes. The execution and then, more importantly, results, of course, remain to be seen. And it could take some time to understand the effects of proposed policy changes and the impacts, of what has already changed. But we're going to be watching news surrounding the creation of a U.S. sovereign wealth fund and news on his position on cryptocurrency. For example, the US government may officially add crypto to its balance sheet, and this will be interesting new territory. Another thing to keep in mind is that US Treasury Secretary Scott Bessent, along with Trump, are warning of short term potential pain in order to achieve economic gain in the coming 6 to 12 months. Keep in mind that Secretary Bessent is different than past Treasury secretaries. He's a capitalist and he does understand markets and business. And so odds are he's going to run the Treasury Department more like a business than his predecessors, which is a major change in Washington. Also, we know that businesses typically like deregulation. So deregulatory policy changes under the Trump administration are of interest to investors. Now, clearly, there's a lot of shakeup happening and definitely a tremendous amount of news to pay attention to. And we caution all investors against making emotional decisions in the midst of all this volatility and uncertainty. Historically, that has often led to poor investment returns for investors. Second thing this month, we're also keeping an eye on recent tax bill, the bill that was passed by the House of Representatives, which will allow Congress to use a special process called reconciliation to advance tax reform. Now, currently, the bill aims to cut $2 trillion in spending while allowing for $4.5 trillion in tax cuts. Now, while it remains to be seen whether Congress will be able to find the full $2 trillion in cuts or whether the Senate will approve the bill, potential tax cuts on the table include extending the Tax Cut and Jobs Act. That was the Trump era tax cuts that we saw in 2017. No taxes on overtime pay or tips, lowering the corporate tax rate for US made products, and also ending taxes on Social Security income. It is still way too early to tell, how this is going to play out. And we're currently thinking we will have some more definitive answers on this front by July. Also, don't forget the March 14th debt ceiling deadline is coming up on Friday, I guess. And we could see a partial government shutdown possible if Congress doesn't act before then. Each time this debate ensues, we see substantial market volatility, which is exactly what we're seeing this week. And once a resolution is reached, things historically have tended to settle down and recover quickly. Now, having said that, though, we expect volatility to continue really for the next several months, probably through the end of second quarter. But we don't currently see this as a reason to abandon a prudent investment strategy. Don't forget that large drawdowns are normal nearly every calendar year, and drawdowns often lead to potential buying opportunities for long-term investors. Third, with new tariffs on China, Canada, and potentially Mexico, we are watching all industries closely, particularly the U.S. steel industry. One particular area I'm watching has to do with President Trump's moves to close loopholes through de minimis shipments. So, this loophole really has allowed Chinese imports coming into the United States, which are often valued at less than $800, to skirt customs enforcement. Okay, so this is really what we've been seeing the past few years, even though there have been tariffs on China. And so, what this means is that U.S. small businesses and consumers haven't felt the full impact of tariffs that have already been in place for the past several years. So, this loophole will now be closed so that low cost items under $800 coming in from China will be subject to higher costs. In the end, tariffs can lead to higher inflation. And it's something all Americans, of course, are worried about. And that brings us to our fourth thing this month, and that is inflation and interest rates. Now, inflation is still rising, and it's something investors should pay attention to. I think we might get a slight reprieve on the inflation front for a few months, but I do expect that the trend this year will be higher overall. Key drivers behind this resurgent include rising commodity prices, wage growth, and shifts in supply chains. And at the moment, it appears that we'll see a rate cut from the Fed sooner rather than later, and more possible rate cuts may begin to be priced into the market. So, the Fed is going to be in a tough spot because cutting rates too soon could accelerate inflation, while keeping them high for too long risks slowing the economy too quickly. I suspect recent moves by the Trump administration may be intended to force the Fed's hands and basically cut rates. And the reason for this is they want to effectively lower the cost of interest that the US government is having to pay on US Treasury debt. So, again, something to pay attention to. Fifth, you know, of course, that diversification is important. So let's talk about diversification across sectors and what you may need to be thinking about as an investor. Leading sectors so far this year include healthcare, up 8.5% as of March 10th, consumer staples, up 5.4%, and real estate, up 4.43%. Having said that, sector leaders have been yo yoing up and down and all over the place. Just a few weeks ago, we saw communication services. That sector, for instance, was leading the way, and now it's not even at the top of the sector performance list at the moment. So, another example of that would be energy. Energy made a huge move earlier this year, and now it's up only 2.07%. So, the biggest story, though, is technology. The tech sector is on shaky ground at the moment, and it's down over 6% year to date. Despite all the talk that surrounds AI, robotics, and space related companies, the Magnificent Seven stocks aren't looking so magnificent in recent weeks. And while we're likely to see a broadening out of performance in S&P 500 companies, the concentration risk that I've been warning about for the past year or more is starting to spook investors. Legendary investor Sir John Templeton was quoted as saying that the four most dangerous words in investing are "this time is different." And this quote reminds us to pay attention and also remain diversified. All right, fifth, so what can you do? First, examine correlation within your portfolio. There's been so much optimism around AI related companies. And while AI still has the potential for opportunities, it's a good idea to evaluate your own personal investment risk and the correlation, or also we call that overlap, between the securities that you hold. If you look at where the speculative money is flowing right now, history teaches us that these sectors have seen major market run ups at times, but when economic cycles shift, stock prices in these spaces can tumble just as fast. And when portfolios become too highly correlated, you can easily get caught upside down when the narrative changes. So keep an eye on correlation within your own investment accounts. And here's a bonus tip for you today. If you're taking a flight and the pilot comes over the loudspeaker to warn you that there may be turbulence ahead, you're going to feel a whole lot better than if he or she does not come over the intercom to announce the potential turbulence ahead. In other words, you'll feel better by having a bit of a warning. So I'm here today to tell you that market and economic conditions are likely to get worse before they get better in the short run based off of everything we're looking at. So buckle up, but don't lose sight of what history teaches us. Investors tend to perform better over the long run when they stay the course and they avoid panic selling. And while every investor is different and should consider their own personal needs and goals before investing or before reacting, our team is here to help you understand the bumpy skies ahead. That's all for this month. Thank you so much for watching and for subscribing to our YouTube channel. We will see you back here for our next video in April.